Wolters Kluwer currently finds itself at a crossroads. After years of being a steady Eddie compounder, the stock has experienced significant turbulence in early 2026, driven by AI fears, regulatory shifts, and leadership changes. The bear case argues that Wolters Kluwer is facing a perfect storm that could lead to a permanent derating of the stock. The primary bear concern is that large language models will eventually allow law firms and accounting practices to build their own internal research tools, bypassing WKL's high-cost databases. This disintermediation risk has triggered a sector-wide sell-off in professional information services. Regulatory headwinds. A major expected growth driver for 2025-2026 was the U.S. Corporate Transparency Act. However, the early 2025 suspension of enforcement for domestic companies by the U.S. Treasury removed a massive projected revenue stream from WKL's Legal and Compliance Division. Leadership vacuum. Longtime CEO Nancy McKinstry, who led the company for over 20 years, retired in early 2026. While her successor, Stacey Kaywood, is an insider, the departure of a legendary CEO often leads to a period of strategic uncertainty and wait-and-see from institutional investors. Internal execution issues. Recent reports have surfaced regarding missed sales quotas, up to 90% in some divisions, and high employee turnover. Bears point to this as evidence that the company is struggling to maintain its growth momentum while trying to pivot too quickly to AI. The bull case rests on the idea that the market is overreacting to AI disruption fears and ignoring the company's deeply entrenched competitive moats. Dominant recurring revenue. Approximately 82% of Wolters Kluwer's revenue is recurring, mostly through mission-critical subscriptions. Professionals, doctors, lawyers, accountants, rarely switch software that is integrated into their daily workflows, providing a highly predictable floor for earnings. AI as an upsell, not a threat. Bulls argue that generative AI is a productivity booster that allows Wolters Kluwer to charge more for its services. Tools like CCH Tagetik and UpToDate are already successfully integrating expert AI, which enhances value rather than replacing the need for the underlying proprietary data. Massive valuation gap. As of February 2026, Wolters Kluwer is trading at a price-to-earnings ratio of roughly 13 to 14 times, well below its 5-year average and its peer RELX. Discounted cash flow models suggest an intrinsic value closer to 140 to 180 euros, implying the stock could be undervalued after the recent sell-off. Aggressive shareholder returns. Wolters Kluwer remains a cash cow, generating over 1.3 billion euros in free cash flow. Management has continued to support the share price with a 1 billion euro buyback program and a growing dividend. Company overview. The strategic architecture of a digital transformation. The fundamental investment thesis for Wolters Kluwer is rooted in its expert solutions strategy, a paradigm that combines deep domain knowledge with technology to deliver content and workflow automation. This strategy is not merely a marketing descriptor, but the engine of the firm's organic revenue growth and margin expansion. By 2024, expert solutions accounted for 59% of total group revenues, achieving an organic growth rate of 7%. This outperformance relative to the group's overall growth underscores the market's demand for high-value integrated tools that drive professional productivity. Revenue dynamics and recurring stability. A defining characteristic of the Wolters Kluwer business model is its revenue quality. The group has engineered a shift toward subscription-based recurring revenue streams, which accounted for 84% of total revenues in the first half of 2025. This high degree of visibility provides a significant buffer against macroeconomic fluctuations and ensures a consistent cash flow profile that supports the company's aggressive capital allocation strategies. The progression of cloud software revenues reflects the migration of the legacy installed base to software-as-a-service platforms. This transition is accretive to margins over the long term, as the cost of delivery for cloud solutions scales more efficiently than on-premise or print formats. In 2024, the group generated over 60% of its revenues and adjusted operating profit in North America, making the Euro/USD exchange rate a critical variable in reported performance. Division Deep Dive. The health segment as a clinical anchor. The health division remains the financial core of Wolters Kluwer, providing clinical technology that drives effective decision-making across the healthcare continuum. The division's flagship product, UpToDate, is utilized by thousands of hospitals worldwide and is frequently ranked as the #1 solution for patient-driven care management and patient education. The UpToDate ecosystem and AI integration. The bull case for the health segment is heavily predicated on the successful commercialization of UpToDate Expert AI, a generative AI solution launched in late 2025. This tool is designed to address the specific needs of doctors and healthcare systems by providing fast, evidence-based answers grounded in UpToDate's peer-reviewed content. Unlike generic AI chatbots, UpToDate Expert AI emulates how expert clinicians reason, leveraging a network of 7,600 medical experts. The performance of the health division in 2025 reflects a bifurcation between clinical solutions and the learning, research, and practice unit. While clinical solutions maintained robust growth, supported by the rollout of AI-powered features, the learning and research side faced challenging comparables from 2024, a period that benefited from the distribution of the New England Journal of Medicine. Furthermore, the ongoing decline in print book and journal revenues acts as a structural headwind. Strategic advancements in medication intelligence. Wolters Kluwer has also expanded its footprint in medication intelligence through the integration of UpToDate LexiDrug and Medispan. In late 2025, the company integrated LexiDrug's comprehensive drug information into UpToDate Expert AI, addressing the fact that nearly 30% of clinicians' questions are drug-related. This ensures that answers regarding medication and therapeutic decisions are harmonized with the broader clinical evidence base. Tax and accounting, harnessing the surge in AI adoption. The tax and accounting division has emerged as a high-growth engine, capitalizing on digital transformation within professional accounting firms. The 2025 Future Ready Accountant Report indicates that AI adoption among global firms rose from 9% in 2024 to 41% in 2025. This shift represents a significant tailwind for Wolters Kluwer's cloud-based solutions, such as the CCH Access Suite. Cloud migration and the advisory pivot. The strategic bull case lies in the maturity of the software ecosystem. Firms that achieved high levels of technology integration reported an 87% revenue growth rate in 2025. CCH Access is designed to enable these firms to transition from compliance-based work to high-margin advisory services. In North America, growth slowed in early 2025 due to declines in outsourced professional services and print books, both of which had exceptionally strong 2024 comparables. This highlights a moderate bear case related to the cyclicality of service-based components, even as the core software remains resilient. Corporate Performance and ESG, the enterprise growth play. The Corporate Performance and ESG (CPESG) division represents the group's foray into the enterprise software market, bringing together CCH Tagetik, Enablon, and Teammate. CCH Tagetik delivered 9% organic growth in the first 9 months of 2025, supported by an 18% surge in cloud software revenue. The primary driver is the need for large enterprises to modernize finance technology as they face deadlines to move beyond legacy systems. Enablon, focusing on ESG and risk solutions, delivered 10% organic growth in 9M 2025 as global regulatory regimes like the EU's CSRD enforce stringent reporting requirements. The Financial and Corporate Compliance Division serves as a barometer of macroeconomic and regulatory health, focusing on legal entity and banking product compliance. Organic growth for the first 9 months of 2025 was 4%, compared to 5% in 2024. The primary drag was the financial services unit, which saw organic growth slow to 1% as stagnant mortgage and commercial lending markets dampened transactional revenues. The Legal and Regulatory, or L&R division, has successfully completed its pivot to a digital-first software provider. In 2024, the division achieved organic growth of 5%. The bull case centers on Libra, the company's legal AI workspace, and the shift toward agentic AI, capable of drafting summaries and reviewing invoices. The bear case for L&R involves the continued drag from legacy print research formats and a deceleration in software growth, falling from 7% to 4% as clients scrutinize legal spending. A critical component of any bull case for Wolters Kluwer is its moat against general-purpose LLMs. The differences between general LLMs and Wolters Kluwer Expert AI include data source. General LLMs use unvetted internet scrapes. Wolters Kluwer uses authoritative codes and peer-reviewed content. Currency. General LLMs often use outdated snapshots. Wolters Kluwer provides real-time regulatory updates. Reasoning. General LLMs rely on statistical probability. Wolters Kluwer uses expert-driven logic and rationales. Liability. General LLMs offer no malpractice protection. Wolters Kluwer tools are built for professional standards.
The bear case also involves currency risks. USD/UR translation risk. Each 1 US cent move in the exchange rate affects diluted adjusted EPS by approximately 4.5 euro cents. As over 60% of revenue is in North America, a weaker dollar dampens reported growth in euros. Debt and liquidity. Net debt to EBITDA increased to 2.2x by late 2025. A current ratio of 0.71 signals potential short-term liquidity concerns. Comparative valuation. Wolters Kluwer versus Relex. EV/revenue LTM. Wolters Kluwer has the highest multiple at 8.5x, followed by Relex, 7.5x. EV/EBITDA LTM. Wolters Kluwer at 25.2x compared to Relex, 20.7x. Organic growth. Wolters Kluwer projects growth at roughly 6% compared to 7% for Relex. Conclusion. Wolters Kluwer is currently a sentiment-driven play. If professional workflows will be too complex for generic AI to replace, the current price offers a rare entry point into a high-quality business at a bargain multiple. However, if the suspension of the CTA and the rise of bespoke AI tools mark a permanent decline in the middleman info service model, the stock can be a value trap.